Well, good morning and welcome to the bank. With me, we've got John McDermott, who's the Chief Economist and the Assistant Governor for the bank, and Willie Chetwin, who's the Manager of the Forecasting team. The Reserve Bank today left the official cash rate unchanged at 3.5%. The global economy continues to grow at a moderate rate, and inflation remains below target in most advanced economies due to spare capacity and declining commodity prices. Our economy is growing at an annual rate of around 3.5%, and we are projecting growth of a little over 3% over the next 2 years. While dairy prices have declined sharply, household incomes and consumption have grown steadily, and construction activity remains strong. Interest rates remain low by historic standards and continue to support domestic demand. Consumer price inflation was 1% in the year to September. Much of the moderation reflects weak global inflation, the fall in international oil prices, and the high exchange rate. The modest inflation pressure suggests that New Zealand's expansion can be sustained for a considerable period with a more gradual increase in interest rates. Underpinning the expansion is the increase in the economy's potential capacity, which is being boosted by high labour force participation, strong net migration, and continued investment growth. Our expectation is that inflation will reach the 2% midpoint of the target range later than earlier forecast, but that some increase in the official cash rate is likely to be required at a later stage. So thanks very much. We're happy to take questions.
Conclusion of the forecasts, there has been a bit of evidence of Auckland house prices going on a bit of a tear again. Have you got any current additional thinking on that phenomenon?
In essence, we follow the RINES data pretty carefully, and the RINES data for November was released, I think, yesterday officially. And what it showed was, house price inflation had peaked at 9.8%. This is for New Zealand as a whole. Had fallen to around 4.25% in October. And we tend to look at the annual increase based on a 3-month moving average. But it had picked up from 4.3% to 4.7%. So there was a pickup in terms of New Zealand inflation, house price inflation. But Auckland had picked up from 7.75% to around 9%. So that's something that we'll need to look very carefully at and follow carefully. It could be that some of it is just a response to the election result, given that there was uncertainty before the election about the tax treatment of housing, for example. Some of it might be seasonal factors. So we'll probably get a better feel for what's happening for Auckland house prices, probably around March or so when that sort of data comes out.
What do you see as the main international risks to this fairly benign outlook, and how worried are you about them?
A favourable development is the decline in oil prices, which are down about 38% since July. I've been around long enough to know that oil markets have enormous volatility, I remember being in the OECD in '86, in the first quarter of '86, when I think Brent crude was trading at $6 a barrel. And I was around in 2008 when I think it was trading at $146 a barrel. But nevertheless, a 38% fall in a few months is a pretty substantial fall. So that's a very favourable development for the international economy. I think the main risks are still around Europe and to some extent Japan. If you look at the US economy, I think it's probably on a pretty sustainable growth path of 3 to 4% output growth. If you look at China, there's still some uncertainty about the housing sector and the construction sector in China. But most forecasters think the economy is probably growing at around 7% to 7.5%, and that can be sustained over the next couple of years. There's question marks, I think, around Japan and certainly in Europe. One of the interesting things is that although the US have stopped the quantitative easing, it's completed its program of tapering. If you look at the intentions in respect of quantitative easing for next year, and you take into account the ECB basically saying they will expand their balance sheet by €1 trillion, and the Bank of Japan has indicated they may do up to 25% further expansion of their money base than previously anticipated, then we are going to see still a lot of quantitative easing in 2015, probably the most, I think, we've seen since 2011.
Governor, I'm just curious about the review that you've got going of inflation, particularly the non-tradables and output gap. What's the sort of, I mean, there seems to be in the report that you get the feeling you might be overcooking it in your forecasts. What sort of chance are you guys thinking that you might be seeing a bit more than what is there?
Well, let me make a few comments, then I'll hand you over to the expert. If you look at inflation, it's running at 1%, and there's two different stories with tradables and non-tradables inflation. Tradables inflation has been at zero or negative now for probably the last 2.5 years, and there's good explanations for what's happening there. I mean, it's a reflection of the high exchange rate, falling capital goods prices, the excess or the global excess of manufacturing, and low inflation rates overseas. So you can sort of explain that. The interesting thing is what's happening with non-tradables inflation. And if you look at the CPI regimen, roughly half of the inflation that tends to come through in terms of the CPI weights is in the tradable sector and the other half in the non-tradables. So it's the non-tradable sector that we model closely in terms of our modelling apparatus. And that's very, very much driven by what do you think is the potential output gap? In other words, how much spare capacity does the economy have at any point in time? And we would say that the economy has been growing faster than potential output for a period, and indeed over this forecast period is expected to grow faster than capacity for the next 2 years. You also look at inflation expectations and various measures of inflation expectations, and we tend to focus quite a bit on the 2-year survey of inflation expectations. Now you then say, well, what does the model tell us about non-tradables inflation as opposed to what's actually happening with non-tradables inflation? And if you look in previous cycles, you've often found non-tradables inflation averaging around 3.25%, 3.5% at this stage of a cycle. But at this point, we're running at just over 2.5%. And, the model, in essence, the things that we're looking at, given that, in essence, our model is showing more inflation than what is coming through in terms of the non-tradable sector. The things that we're looking at are the potential output gap, the relationship between potential output and actual output. or the amount of surplus capacity, or in this case, negative surplus capacity. Do we have that right measured? Do we have that measured correctly, or are inflation expectations in fact lower than what some of the survey data is showing us? But let me hand over to John if there's anything extra you'd like to say, or indeed any corrections you'd like to make.
Oh, no corrections at this point, no. I think, just stepping back though, there's answering your question about whether we've under or overcooked it. I think you have to remember there's a good news element story here. Inflation has turned out to be lower despite the absorption of capacity, and that gives us a lot more options with monetary policy going forward. And is part of the story here where we see the growth profile actually lasting longer. So we now have a story where the economy is above trend for longer than we had back in September. And probably a profile where the unemployment rate also comes down more than would otherwise be the case. So there's actually a very positive aspect to the story. The other interesting thing is this is not a New Zealand unique story. This is going on around the world where inflation is coming in a lot lower than a lot of people have previously thought would happen.
What can you tell us about the Reserve, sorry, down the back here. What can you tell us about the Reserve Bank's projections for the export market and also, well, in particular, the dairy price recovery?
On the dairy price, in terms of our own forecasts, you've seen. We think of it not in terms of a payout in dollars and cents. We tend to forecast what we think. We tend to forecast the US dollar per metric ton of whole milk powder. So we've seen the current price fall from $5,000 US a ton to around $22.20 US a ton. In terms of our forecasts, we've got it recovering to around $3,200 US a ton by late 2015. In terms of other commodity prices, I mean, you're seeing record prices for beef exports. Timber has picked up a little bit lately. Wool prices and meat prices have been increasing. We think the outlook for those continues to look promising.
What can you tell us about the measures that the Reserve Bank is considering to try and stop investors from buying multiple houses and push first home buyers out of the market?
Well, maybe Grant can add some comments as well. But in essence, we went out and consulted earlier in the year about the risk weights that should be applied for this asset class, and whether they should be different from the risk weights applied to normal lending in respect of owner-occupied residences. And so we started thinking about, well, how would the risk class differ? Because we think that there's different default risk or different credit risk with that sort of activity. And we went out and consulted on an arrangement where we'd been talking about an investor having up to 5 properties. And now we've got some feedback on that, about some of the issues, about how easy that would be to apply. And we've been looking at whether there's alternatives around that in respect of thinking about debt servicing capacity in relation to other income that the investor might have. But let me see if Grant wants to add something or modify it.
Well, that's essentially right what Graham's saying. We're really just looking for to define a separate asset class for investors.
Do you mind just for camera's sake, swivel around and say otherwise we're just going to get the back of your head for us.
Sorry about that. Yeah, we're looking to define a separate asset class for mortgage investor lending. It's something which most banks, would make a separate assessment for an investor loan anyway. But there's a lot of different approaches across the bank, so we want to try and get greater consistency, uniformity. So we've been talking to the banks about their different approaches over the past year. It's taken a bit longer than we thought. Initially, we had this 5-property sort of rule that we were going to use, but now we think that's probably not the best approach, and we're now talking about an income-based approach, the amount of income coming from a property portfolio versus the borrower's total income. And we're going to consult on that, put a proposal and consult on it in the first quarter.
Just watching the microphone.
Governor, is the Reserve Bank considering using other macro-prudential tools to slow down the housing market, which seems to have gotten a second wind in the last couple of months?
No.
And just looking at the inflation target of about 2%, I see from the monetary policy statement that you're forecasting CPI inflation of actually under 2% for 5 years up until September 2016. Do you think you have run monetary policy too tight?
No, I don't think so. I mean, you've had the economy growing faster than potential output for some time. I mean, the economy's growing at this point probably around 3.5%. We think potential output's probably just under 3%. So you've been using up surplus capacity pretty quickly. And monetary policy is still expansionary. There's always this issue about what is the natural rate of interest, which is basically the rate of interest that would be consistent with an economy growing at potential output and the central bank meeting its inflation target of 2%, or at least the midpoint. So that's the sort of concept of the natural rate, and it's a model-based concept. Now, we think that that rate is probably somewhere around 4.5%, but there's some uncertainty around that. It may be below 4.5%. So we would still say at 3.5%, the OCR is low by historic standards. It's still expansionary for the economy. And moving earlier, in essence, reduces the risks that we'll have to increase rates more later on in the cycle. So no, we don't think we've made monetary policy mistakes.
Do you think, though, that there might be some structural forces dragging down on inflation, which mean that you have perhaps overestimated inflation and also underestimated the productive capacity of the economy?
Well, I'll get John's thoughts on that too. But, a lot of what's driven the inflation is what's been happening in the tradable sector. And as I said, if you look at what's been happening for capital goods prices internationally for a long period now, particularly around information technology, for example, you look what's happening in terms of global oversupply of manufactured goods coming out of China and elsewhere, and you look at low inflation in general in those economies, particularly out of Europe, and you look at the high exchange rate, then you can explain non-tradables inflation, and it's been tradables inflation, and it's been a big factor in the low inflation outcomes. The issue, as I say, is really around non-tradables and whether the potential output gap is different from what we've talked about in terms of our modelling, and whether indeed inflation expectations are lower. You can look at things like pass-through in terms of exchange rate into prices, and when we look at that, by and large, the relationships seems to be pretty well what we'd expect. You can talk about what's happening with purchases on the internet, for example, and whether that's changing retail margins. But when we've looked at that, and we're still doing analysis in that area, but that still doesn't seem to be an explanation for what's happening here. you are seeing wage outcomes, wage inflation, low in a number of countries. Whether that's driven by more adaptive expectations, that people have seen inflation fall to very low levels, and that's reflecting their demands for wage increases. That may well be a factor, but let me see if John wants to add anything.
Yeah, I just wanted to emphasise the fact that low inflation is largely due to tradables inflation being about -1%. And in that basket are a lot of items that monetary policy has very little impact on. And can be very volatile as well, like oil prices. And so what you expect is when you've got very low tradables inflation, on average, you'd be in the lower part of the inflation band. And when tradables inflation is running very high, you might be in the higher part of the band. So we think we're roughly where we would expect to be. And if you're trying to gauge whether you've got your monetary policy settings right or wrong, it's important also to measure what's going on in the real economy. So the fact is, at the moment, again, we've got growth above trend and unemployment falling. So there doesn't seem to be anything inconsistent between growth and inflation going on here. In fact, it's actually quite a positive story.
It looks like the Kiwi jumped up quite a bit on the back of this statement. So I was just wondering if you're considering further intervention to smooth it out at all.
No, we'll stay out of that area of intervention in terms of my comments. I'm not talking about actions or otherwise, but no, I'd rather not talk about intervention. But we were a bit surprised just at 9 o'clock to see the rate jump so much. I mean, that was a bit of a surprise. We'll see what happens over the rest of the day.
How worried are you that you can't explain what's happening with non-tradables inflation? How worried are you about that?
Well, if you look at, how significant is the unexplained at this point factor? I mean, in essence, it's probably somewhere around 0.4 to 0.5 on the non-tradable side, which then if you look at total inflation, it's probably around about 0.2 or 0.3 that in terms of aggregate inflation. But did you want to add anything, John?
No, that's the scale of the forecaster, if you like, which is actually quite small. And certainly many other forecasters have been making similar, if not larger, errors. So in terms of history, it's a small error. But it's an interesting one in the environment of very low inflation. And so what we've done is laid out a framework about how do we monitor this. What would typically happen at the current point in a business cycle where you're moving from a period of lots of capacity and that capacity is being used up. You'd start to expect non-tradable inflation to have moved already. It hasn't. And so as you move forward, those are the things you have to be carefully monitoring to see if the concerns actually increase or decrease.
Governor, I just wanted to ask you just about the going back to the implementation of other macro tools. Have you done any modelling of how much you think that would save you, I guess, in terms of OCR increases if you put in place this investor-based tool?
We don't I'll hand you over to Grant, but we don't see that as a macro-prudential tool. I mean, it's more. Think of it more in terms of micro-prudential policy, and the issue is whether we have the right capital allocation, if you like, the right risk weight in terms of asking the banks to put aside capital to commensurate with the risks associated with this type of lending. And are those risks different from, say, somebody going in and saying, I want a mortgage for an owner-occupied house? So we think of it in terms of micro-prudential tools, and we haven't done any modelling in respect of the OCR around any of this.
On that, I just wonder though that we have heard from business groups saying that they would like to see a cut. And if the housing market is the problem that you're most concerned about, obviously bringing in other tools to deal with that should be your first port of call. And so I wonder if you do bring in this tool, or when you bring in this tool, does that mean that you might then consider something like an OCR cut if it is warranted?
we're not anticipating an OCR cut at this point. I mean, if you look at house price inflation, if you look at the latest RINES data, and as I say, take the annual increase based on a 3-month moving average, which we feel gives a better indication. If you look at Auckland house prices, they're running at around 9. Christchurch, I think, around 8 to 9. But for the rest of New Zealand, they're running at around 2. So the issue is really Auckland house prices and Christchurch house prices. Then the Christchurch house prices, I think supply will take care of itself in Christchurch, that the houses will be built. We'll see house price moderation, and indeed the economics team down in Christchurch, which is what are they called? The Canterbury
Development Corporation.
Canterbury Development Corporation are forecasting surplus housing in the medium term, and quite considerable surpluses in Christchurch. So the issue is really around Auckland in that sense, and that's why I said we want to get a feel for what's happening once we get into, say, February or March. The Auckland issue is a supply issue. It's a supply issue. I mean, they've got a backlog at this point of probably 20 to 30,000 houses. They need, according to the council, 10,000 houses a year for the next 30 years. Permits are currently running at 7,500, which is a big step up of about 30% over where it was last year, and it's double where it was 2 years ago. But they still need a lot more housing supply in Auckland. I mean, so if you look at the housing market, you look at Auckland, you look at Christchurch, and then you look at the rest of New Zealand, it's Auckland in supply that's the issue, and the regulatory issues around all of that as well. Yeah, sorry, Patrick, was there anything else?
Yeah, I was just going to ask though, but I guess from a business point of view, and we saw with the Shadow Board's latest missive where they were talking about, Dave Taylor, one of the participants on the board, was saying that he favoured a cut. Now, he's with Steel and Tube. He favours a cut down to 3.25%. Again, I just go back to it, if it's the housing market which is the issue, I guess business are feeling that they're the ones actually having to pay the price for that, particularly in this environment of low inflation. So, I mean, are you saying that their views should be discarded here, or are not as important as the overall economy?
Well, I'm saying that the economy is growing at this point around 3.5%. It's an excessive potential, and that's going to continue, we think, for the next 2 years. We do see inflation starting to increase, inflation pressures. There's a lot of uncertainty around inflation. Even though it's low, there's still a lot of uncertainty. We might see further declines in oil prices, for example, and that'll start to come through in the next quarter or two, for example, if it stays at $66 a barrel, Brent crude, for example. So the 38% decline is maintained. There's a lot of uncertainty about the migration outlook. It's running at 48,000. I think everybody's been surprised at that. And there's good prospects, I think, that the migration will continue to remain strong. And then you're seeing business confidence still at high levels, which is good. So as John says, it's very much a good story. It's not a story where we see the need for any cut in interest rates. Certainly not at this point.
You've acknowledged that you have little or no influence on long-term interest rates, and I wonder, therefore, how concerned you are to see the shift that's occurred from floating to fixed mortgage rates. Is there any risk the bank losing traction or having spongy brakes as a result?
Spongy brakes is a good expression. There's little that any central bank in a small open economy with a floating exchange rate can do in respect of long-term interest rates. And you're seeing internationally very low 10-year bond yields. I mean, if you just simply took the Bank of Japan, it's, I think, about 0.47% at this point. You know, the 10-year Deutsche, 10-year German Bund is, I think, around about 0.7 or thereabouts. So they're very low long-term interest rates. We do look carefully at what happens in terms of the swap curve and what's happening out at 2-year and 3-year horizons, because that does affect fixed-rate mortgages around that tenure. But if at this point, 60% of the mortgages, if you like, the mortgage stock out there is either floating or is maturing within the next 12 months. And the duration of the New Zealand mortgage market is incredibly short by international standards. So we're not overly concerned about that move at present, although we do watch it carefully.
Just going back to what you said about not cutting the OCR and that you haven't made any monetary policy mistakes this year, doesn't the fact that you can't explain what's happening to non-tradables inflation suggest that you might also be wrong on the capacity of the economy to grow? You've already revised that up considerably from what it was at the start of the year.
Well, again, I'll let John have his thoughts as well. But look, these are, one should always be humble as a forecaster about forecasting the real economy and certainly relative prices such as interest rates and exchange rates. So these are forecasts that are conditional projections based on assumptions about the exchange rate and these sorts of things. The bit that, in terms of our modelling, that we can't explain is really a very small part of overall inflation. I mean, what's driving inflation, as we've talked about, is what's happening in the traded goods sector. But, John, did you want to add anything?
Yeah, there's a couple of points. I think if we'd have not been so clear in the statement that the size of the forecast story, you'd have probably never even seen it. So there's some sense in being very transparent in outlaying what's going on here. We're talking a forecast story historically that is very tiny. But the important point, as everybody is in the world, and actually the forecast story that the bank has been made is smaller than anybody else in the market. So that's the perspective. But let me also highlight, this is always the case. You can never perfectly know the capacity of the economy because it's always changing. And the way you deal with this is you form a plan, you be as clear in that plan as you can be, and as you move through time, you evaluate how close to that plan you're going to be. And you can never be perfect, but if you're close enough, you say, okay, that was a reasonably good assessment and we'll move forward and carry on with the plan. And if things have deviated, every 6 weeks you get an opportunity to change that plan. And so that's how we're unfolding what's going on here. And we're sort of feeling our way through the process and saying, oh, actually, this economy just has a bit more capacity than we thought 3 months ago, and a bit more than we thought 3 months before that. And that's how you learn, and you adapt to the changing environment. And so that's the framework with which we're operating with, because you'll always make mistakes. The process is to have a system that mitigates against those errors that will always be there.
I just wanted to ask about the dollar comments you've made today. You say, you've repeated again, that you expect a significant drop in the exchange rate and that you were surprised at the big jump we saw this morning. What gives you confidence that the exchange rate will drop when you're one of the very few central banks in the world to be talking about raising interest rates?
I think two things. One is what's happened to dairy prices. I mean, a 55% decline in dairy prices, given that dairy exports are about a third of our merchandise exports. That's a big adjustment. So that's the first factor. The second, forgive me, I'll just get my thoughts together. Forgive me. John, did you want to carry on?
Oh, I think the important thing is when you're thinking about the exchange rate is New Zealand is a commodity currency. and that will drive a large element of what's going on here. I think. Can I stick with that point? I think that's yeah.
Sorry. Oh, the dollar story. Yeah, no. You know what you're seeing at the moment is maybe the start. Time will tell. Of a strength in the US dollar. And if you look at real exchange rate swings in the US dollar, they tend to be quite long. And you can go back over the last 3 big cycles, and it's not unusual to see an upswing in the US dollar of something like 4 to 5 years. Now, I think most traders came into this year expecting the US dollar to appreciate, given what happened in May last year around tapering. And given that tapering did actually start in December, they came this year expecting the US dollar to appreciate. It looks as if we're now starting that phase. And in fact, if you take our cross rate with the US since July, we're down, I think, around 13% at this point.
In Australia, APRA and ASIC have said they're going to do more intense supervision of banks, particularly around rental property investing, and have said that they want to see the banks be tougher on serviceability rules. What's the Reserve Bank's views here on whether it needs to do something similar, particularly around investor lending?
Did you want to offer any thoughts, Grant?
Yeah, well, I think the Australian situation's a bit different in the sense that they have seen a rapid growth in investor lending. In the mortgage market, we haven't seen the same growth here, so there's not the same sort of risk concern around that sector. They've also, been doing analysis around interest rate buffers, around debt service ratios, and it's their response to the emerging situation in the Australian market. I think there's a broader issue around the Australian Financial System Inquiry, where they're looking at broader capital ratios, and there's recommendations come out of that may potentially have implications for New Zealand. We'll have to look at that, but it's pretty early days at this point. This was the Murray Inquiry recommendations that came out on Sunday.
Could the Reserve Bank look at also increasing the capital weights, particularly for residential lending, in the same way that it appears that APRA may do there?
Well, to some extent, we're already ahead of APRA in the sense that the risk weights in New Zealand on mortgage lending are higher than they are in Australia. So they're looking at, they're recommending increasing those risk weights effectively in Australia. We're always reviewing, and we agree that there's a case to look closely at internal ratings-based models, and we're running a benchmarking project at present in terms of more carefully assessing the internal ratings-based approach and risk weights that come out of that. But so there are some lessons from what's happening in Australia for us, but there's no obvious significant change in policy.
Let me come back to the exchange rate comment that I was going to make. I mean, part of it's the terms of trade, part of it's the US dollar story, but it's also the fact that we've indicated since July that we're on pause. And if you look at our inflation forecasts, we've got lower inflation for longer. We've got the market analysts, by and large, who don't envisage at this point an increase in the OCR probably till around about the September or December quarter next year, I think is probably the modal type projection. If you look at the OIS market, basically nothing's priced in at this point until about the first quarter of 2016. So market expectations, either from market analysts or from OIS pricing, is that the OCR is likely to remain at its current level for a considerable period. At the same time, those expectations are out there that, and it varies, but that the Fed will probably start tightening around about June or thereabouts. So we may be in for an interesting dynamic as we go through the year. So that's why we were a bit surprised when we saw the 9 o'clock jump up in terms of the signalling that's commensurate with the MPS.
Governor, just on fiscal consolidation, I think in the report it indicates about just a bit more than 1.5 percentage points over the forecast horizon. Is that consolidation still working with monetary policy? Do you still need the government to clamp down on its spending to help you guys?
When you've got an economy growing at 3.5% or above potential and you're expecting that to continue, then the government moving towards its fiscal objectives of achieving a surplus is something that's helpful. It's not pushing against monetary policy by going out with a large fiscal expansion, for example. So it's supportive of fiscal policy. We build in there the Treasury's forecasts into our own modelling. One way to think about this fall in oil prices is similar to a tax cut. So, you're seeing household disposable income as this flows through into the CPI. You will see an increase in real disposable income. So that's going to be an expansionary factor for the economy. Good. Well, thanks very much indeed.